Welcome to this video. We're going to talk about cap rates and also their relationship to mortgage rates. So I came across this pretty nifty graph that I wanted to go through with you. This is from Reventure Consulting. It looks like they used BLS and Zillow data. And what it shows is this is actually single family houses, not multifamily, but the correlation is so similar that I think it's worth going through and seeing what this graph represents and how investors think about cap rates, especially in relation to mortgage rates. So let's concentrate on this blue line here. I apologize. This blue line here talks about cap rate. So what is a cap rate? It's really the cash flow you can expect to receive, from an investment. So, for example, if I bought a $1 million house and the cap rate was 5.5%, I could expect to receive cash flow of around $55,000 on that $1 million investment. Now, that's assuming I pay cash for the property, and that's after I pay for property taxes, other expenses such as insurance, maintenance, upkeep. Does not include mortgage payments. So if you get a mortgage on it, the cap rate does not factor that in. So what it does, it gives a level apples to apples comparison of property to property. And this blue line here represents an average of those cap rates across the market. So some are going to be higher, some are going to be lower. Typically the nicer ones are going to be lower than that blue line. Properties in maybe tougher neighborhoods that are older product are going to be higher than that blue line, but it all averages out to that blue line. And again, we're specifically talking about single family houses here. And really what we're looking at is how this graph, this line it's edged down, and this starts in 2011. It's edged down from about 5.1, it's gone up a little bit, but fast forward about 13 years, we're at 4.4%, which is about 0.7% lower than over a decade ago. Now you might be thinking, all right, we've had a period in the past 4 years where prices for houses and multifamily and commercial buildings in general have spiked. And it isn't really represented here by the cap rate. Now, cap rate is going to be inverse, so a spike in prices is actually going to show a drop here in cap rate. But why it's gone pretty steady in the past 14 years really comes down to the fact that rents have also been keeping pace with the price of homes. So you've got to think of cap rates as rent prices as a function of the actual purchase prices of homes. So homes have gone up, but if you were to rent them out, rents have also gone up. And that's no accident. It's kind of the market balancing each other out. If you have a property that think that you're a renter. If you are renting and suddenly the housing market takes a crash, you may then consider going to buy a property, which is going to somewhat prop up prices. So it kind of balances each other out. And that's what we get with this steady line here over the past 14 years, even though prices have been doing some pretty crazy things, especially in the past 4-year period that we've just experienced. So really to go through a quick example, I have $1 million house. I said that at 5.5% cap rate, I can expect to make cash flow wise around $55K a year on my investment. So $55K a year after I pay my property taxes and my maintenance. What this orange line represents is the actual debt interest payments. So most people do finance homes, they do finance multifamily property, and the goal is to arbitrage this orange line and this blue line. So if you have a property that is making you, call it 5.5% on $1 million property, that would be $55,000 a year. This orange line is effectively your cost of the debt, the mortgage. So this is the interest payments you're paying. So again, using the $1 million property example, around that point is around 3.7%. So $37,000 of this property, assuming you financed it 100%. Again, just trying to keep this example as simple as possible. You're making $55,000, but then you're paying $37,000 to the debt service, the interest payments, and so you're left with $18,000 in profit. So that is pretty good, considering where we're looking at today, which I'll get to in a minute. But that is the goal for cash flow investors, is to arbitrage this cap rate line and this orange mortgage rate line. So you can see mortgage rates have gone down, they've gone up. Common misconception is that the Federal Reserve, dictates mortgage rates. There is definitely a correlation there, but the market kind of does its own thing. You can see throughout this time, the Fed definitely wasn't lowering and increasing and lowering. They tend to keep pretty steady. And when they do increases, they do a number of increases. When they drop them, they do a number of drops. You can see here is when mortgage rates really started to increase. And it's important to think about when this orange line crosses this blue line, that's when you're negatively or you're neutrally leveraged. So right here, it happened around 2019. Cap rates were around 4.9%. So $1 million property, you're making $49,000 in cash flow from it. But your debt payment is also, your interest payment is $49,000. So you're effectively making zero net cash flow if you bought it this time at this cap rate with this interest rate. And I should point out that this doesn't include appreciation. So if you actually bought it 2019, you'd have done pretty well for yourself, because we all know that home prices did spike over the past few years. So even if you're making zero in terms of cash flow, appreciation wise, you could have built in some good equity into that property. So this is purely talking from a cash flow standpoint, rents versus the purchase prices. So as we go along here, we know that the Fed started increasing interest rates, which caused the mortgage rate market to go up. And it crossed this point here where the cost of financing the property actually exceeded what the property was making. So on average, if you purchased, let's call it end of 2023 when it reached the peak, cap rates were still around 4.4% on average. So on $1 million property, you're making $44,000, but your debt payment, your interest payment would have ballooned to $76,000. And so here actually underwater, and it's the opposite of the situation over here where you were trying to arbitrage. Now you're negatively arbitrage here. It's actually costing you to hold that property. Why is it? Why did investors continue to purchase properties even though they were upside down in this equation? Well, it's really public perception, and this is what I always say, is that it's not just important where the mortgage rates are at or where the Fed fund rates are set at, but it's important what is the perception of what's going to happen in the future, because that drives speculation. And the perception that the Fed was giving us was that we're going to increase interest rates in order to get this inflation under control. But the expectation was once it's under control, they're then going to cut interest rates. So people that were buying in this period here, the past few years, they were effectively saying, I'm going to swallow this negative cash flow situation. But I know that once the Fed does drop rates and mortgage rates do drop and we go back below this line, can refinance out, say we get to 3.3%, can refinance out, and now you have that positive leverage situation again. So that's the play that investors in the past few years have been looking at. Again, this is independent of appreciation. That's a completely different story. If prices tank, they could still well be underwater. But as far as the cash flow perspective, really arbitraging these two lines is what you should be looking for as an investor. Now, that's obviously the single family homes. Multifamily relate in a similar way. The last graph I want to go through is pulled from CoStar, actually. And this is I know my head is covering it, but it starts in the year 2000. So this is average cap rates of multifamily properties. If you pay attention to the yellow line, this is all across the United States. We do have Miami properties, which is the green line here. Not too concerned about the actual numbers themselves, but looking more so at the trend line. So what do we notice since 2000? And probably I would have loved to have gone back before this, but it's a lot tougher to get the data. Cap rates on multifamily properties have generally been on the way down. What does this mean? It means that investors are willing to take less cash flow for properties as time has gone on. So back in this era here in the 2000s, investors were really saying, hey, I'll invest in multifamily if I can get a 9% return annually on it. As time has gone on, it's gone down and down and down, and this is a function of interest rates. Interest rates do play a factor in this, but also non-interest rate factors such as multifamily being seen as a lower risk investment profile, multifamily becoming more common, apartment buildings becoming more common. I'll also say that multifamily has caught the eye of a lot of institutional investors, corporations who previously never were invested in multifamily. I'm thinking of Blackstone. Blackstone has a large real estate holdings and has built it up over the past 10 or so years, especially. It used to be a lot of individual owners owning at this point, but now this has all worked to drive market cap rates down. And we got to say that it can't just keep going all the way down to zero. It won't make sense at that point. And CoStar has actually tried to forecast what they believe, market cap rates will look like in the future. Always take it with a grain of salt, but you could look at this and say that, hey, cap rates, they're trending down. They're probably going to stabilize around that, 5 to 6% rate. Again, you can get some that are a lot lower. You can get some that are higher. But what are the reasons that market cap rates are declining? Those market forces are in place now, and no one really knows. But I wanted to show this representation to see what cap rates have done over the course of many years, not just looking at it from month to month and year to year as a lot of investors do. So it's often prudent to step back, look at what cap rates are doing, what they've historically done. We can see a bump here, prices going down over the global financial crisis. They actually went the other way during the pandemic by virtue of a lot of money being printed. And this can give you a good feel for overall what investor sentiment is on multifamily apartments. So that's this video for today. Thanks for listening, and we'll see you next week.